What if I told you that you could triple the daily returns of the NASDAQ 100, one of the best performing indexes in the world? It honestly sounds like an investor's dream come true, doesn't it? A potential shortcut to some really incredible wealth. And for some people, it absolutely has been. But, and this is a huge but, this kind of power comes with a serious and very often misunderstood catch. So in this explainer, we're going to dive deep into the high-stakes world of leveraged ETFs, focusing on the powerful and dangerous siren's call of TQQQ. To really get why TQQ is so incredibly tempting, you just have to look at the raw numbers. Let's imagine you invested $1,000 a month, every single month for the last 10 years. The standard QQQ, which tracks the NASDAQ 100, would have earned you a very respectable 175%. Not bad at all. But its 2x leveraged cousin, QLD, would have delivered almost 400%. And then, you see it over there on the right, there's TQQ, the 3x version. It delivered a staggering, absolutely jaw-dropping 580% return. That level of outperformance is almost impossible to ignore.
And if you think that's wild, check this out. If we look at the total return since TQQQ was created back in 2010, the picture gets even more insane. We're talking about a mind-bending 6,165% return. And that includes several massive portfolio-crushing drops along the way. To put that into perspective, a single $10,000 investment at the very beginning would be worth over $700,000 today. It just completely dwarfs what you would have gotten in a standard index fund. The performance gap is, well, it's almost unbelievable.
So what is the magic behind these incredible numbers? How does this even work? Well, it all comes down to the 3x promise. This is the core appeal of TQQQ, and it's the very first thing we need to fully understand.
Okay, so here's the fundamental difference, and it's super important. This standard QQQ ETF is pretty simple. It just buys and holds the 100 stocks in the NASDAQ 100 index. Easy enough. TQQQ, on the other hand, is a whole different beast. It doesn't just hold the stocks. It uses a really complex mix of financial instruments called derivatives and a lot of debt to amplify the moves of that index. And it does all this with one crucial goal: to deliver 3 times the daily return. And I'm telling you, that one word, daily, is the absolute key to this entire story. Everything hinges on it.
Now this leads to the obvious question, the one that so many curious investors ask. Hey, the stock market generally goes up over time, right? So why wouldn't I just buy TQQQ, hold on to it for 20 years, and let that 3x leverage make me unbelievably rich? I mean, it seems like simple math, but this right here, this is exactly where we find the catch. This is where the dream can turn into a nightmare. And that brings us to what I call the daily reset trap. This is without a doubt the most critical and most misunderstood mechanic of how these leveraged ETFs work. And it explains exactly why 3 times the daily return does not, and I repeat, does not equal 3 times the yearly return.
The engine that drives this trap is a concept called volatility decay. Now, this isn't some kind of flaw or a bug in the system. It's a structural feature. It's literally how it's designed to work. Because the leverage is reset every single day, the constant compounding in a market that goes up and down creates a performance drag. You can think of it like a hidden tax on volatility. Essentially, you can lose money in 2 out of 3 scenarios: when the market goes down, which is obvious, but also when it just goes sideways. Let's get our hands dirty with some super simple math to see exactly how this plays out. Imagine both an index and TQQQ start at a value of 100. Okay, on day 1, the index has a bad day and it drops 10%. Down to 90. TQQ does its job perfectly and drops 3 times that, a painful 30%, which takes it down to 70. Now, on day 2, the market has a great day. The index rallies 11.1%, which brings it right back to where it started, at 100. TQQ also rallies, gaining 3 times that, or 33.3%. And here's the result. Here's the punchline. The index is completely flat. It's back to 100, no harm, no foul. But what about TQQQ? Well, that 33.3% gain was applied to a smaller base of 70, not the original 100. So it only recovers to a value of 93.3. It's still down nearly 7%. That gap, that loss that just seems to appear out of thin air, that is volatility decay in action. It's the hidden price you pay for daily leverage.
Now this decay, this constant drag, it leads to another really serious problem: the math of amplified loss. You see, recovering from a drop isn't symmetrical. If you lose 50% on an investment, you don't just need a 50% gain to get even, you need a 100% gain. And with 3x leverage, this recovery problem becomes exponentially, terrifyingly harder.
Let's look at a real-world example from the 2022 bear market. QQQ fell about 33%. To recover from that, it needed to gain about 50%. You know, that's a big climb, for sure, but it's feasible. Now, look at TQQQ. It absolutely cratered. It lost 79% of its value. To get back to its previous high from that low point, it needs to gain a staggering 376%. You're not just digging out of a hole at that point. You're trying to climb out of a canyon, a very deep canyon.
And if you thought the danger stopped there, well, I've got some bad news. Beyond that nasty volatility decay, there are other hidden costs just eating away at your returns. For one, TQQQ has a much higher expense ratio. We're talking almost a full percent compared to QQQ's 0.2%. That's to pay for all the borrowing and derivatives. It's also way less tax efficient because of all the constant trading it has to do. And here's the scariest part. In a truly extreme crash, like if the NASDAQ dropped over 33% in a single day, the fund could theoretically be liquidated, wiped out, gone.
Okay, so after hearing all of that, you might be thinking, no one should ever touch this stuff. But here's the thing. TQQQ is a tool, and like any powerful tool, think a chainsaw or a blowtorch, it can be used effectively and even safely, but only in the right hands. So let's shift gears and look at how sophisticated traders, and I want to stress the word traders, not investors, attempt to tame this beast.
Okay, this is probably the single most important principle in this entire explainer. If you only remember one thing, please make it this. These are not buy and hold investments. Let me say it again. They are not designed to be held for the long term. Because of that volatility decay we just spent so much time on, they are explicitly designed as short-term trading instruments, often for a holding period of just a single day.
So one approach traders use is to remove all emotion from the equation and rely on a strict rule-based system. For example, a market veteran named Leslie Masonson proposes a strategy based on a long-term trend indicator. It's simple. You check if the regular QQQ is trading above its 225-day moving average. If it is, that signals a strong uptrend, so you hold TQQQ to capture those amplified gains. But the second it drops below that line, you sell and move to cash. The goal is to avoid those brutal downturns where leverage is the most destructive. Now, another strategy is that disciplined dollar-cost averaging we saw earlier, the one that created those huge returns. This approach, though, demands an almost robotic ability to stick to the plan. You invest a fixed amount regularly, whether the market is soaring or crashing. The absolute key is to keep buying during the terrifying downturns to lower your average cost. But this is a high-wire act. It relies entirely on a long-term upward market trend and having the iron nerve to watch your portfolio get absolutely decimated without panicking and selling at the bottom. And finally, you have the active day traders, the very people this product was arguably designed for. They live by a strict set of rules. First, you always set a stop loss. That defines your maximum acceptable loss on any given trade, period. Second, and this is a huge one, they almost never hold a position overnight. Why? To avoid the massive risk of a gap down at the next day's market open. And third, they do not average down on a losing trade. With the 3X ETF, that is a recipe for absolute disaster.
So, let's bring all of this together for the final verdict. We've seen the incredible, tantalizing promise of TQQP, but we've also seen the profound peril. So what is it? Is it a powerful tool for generating outsized returns, or is it simply a time bomb just waiting to explode in your portfolio?
Well, ultimately, the verdict depends entirely on who you are as an investor or trader. QQQ is a fantastic instrument for long-term investors, people who want broad tech exposure with a simple, effective buy-and-hold strategy. TQQQ, however, is for someone else entirely. It's for a sophisticated, active, short-term trader who deeply understands all the risks we talked about, who has a strict strategy in place, and who possesses an extremely high tolerance for pain and volatility. And as a final, memorable warning, I want to leave you with this piece of advice. The legendary trader Paul Tudor Jones reportedly kept a sign on his office wall that just said this: "Losers average losers." It's a powerful, blunt reminder that while averaging down can sometimes work for long-term investors in high-quality assets, doing it with a volatile, leveraged instrument can be the fastest way to wipe yourself out completely. So we end right where we began. The promise of supercharged returns is very, very real. But so is the danger of a portfolio time bomb. And the deciding question isn't really about the market or even about the ETF itself, it's about you. So you have to ask yourself honestly, what is my true tolerance for risk?